Hi everyone, my name is Rajita. I'm lecturer in commerce and working at Government Degree College, Mortad. Topic is ombudsman. Ombudsman is a quasi authority for the resolution of problems reported by customers of banks. So each bank can have separate ombudsman for clarifying and resolving the problems which are reported by customers or bank employees, even including. So the ombudsman is the problem solving authority. So customers can complain against the services rendered by the banks if the customer is not satisfied with the services, so they can complain uh, on the services uh, to ombudsman. The ombudsman scheme was first introduced in 1995. Again, it was revised in 2006. The current ombudsman policy is introduced in 2016. There are some amendments are there in 2017, and next, ombudsman authorities and process of resolving problems which are reported by customers. So there are some situations in with which the ombudsman will take action and try to resolve the problem. The first one is non-payment or inordinate delay in the payments or collection of checks, drafts and bills. If there is any delay of collecting customers' checks or drafts or bills or payment of checks or bills or drafts, the customer can make a complaint with the ombudsman to resolve the problem which is generated. Non-acceptance without sufficient cause of coins tendered and for the charging of commission for these services. If the bank is refused to accept the coins which are tendered by the customer, and if they are charging for the coins, so this is one of the non-cooperation from banks. So the customer can complain against banker in ombudsman. And the next situation is non-payment or delay in payment of inwards remittance. If the bank is delaying or non-paying, so it can also be a complaint. The next one is failure to issue or delay in issue of drafts, pay orders and bank checks. If the bank is ignoring the customer's request, or if they are fail to issue the drafts, pay orders or checkbooks, it is a non-cooperation for the customer. So the customer can make a complaint. And the next, delay in receipt of export proceeds, handling of export bills and collection of bills. If any kind of delay, any kind of late is happening in these kind of situations, it is also non-cooperation. And a refusal to open deposit account without any valid reason for refusal. If the banker is refusing to open an account in their bank without any cause, it is against the rules of banks. And the next, levying of charges without adequate prior notice to the customers, without informing the customer. If the bank is charging any charges. So this is also against the rules. And closure of account without customer consent, without informing the customer. If the bank is closing his account, it is also a, a problem or non-cooperation. And financial loss incurred to customer due to wrong information given by the bank officials. If the bank is giving wrong information to the customers, with that information, if the customer incurred loss, so it's absolutely a problem for complaint. And the ombudsman is appointed for 3 years of tenure. Zero balance account. It is a system of cash pooling. Cash pooling means consolidating the current accounts balances into a single company. So with this system, the cash can be pooled into the better interest rate and useful and making value to the money. This is the zero balance account. And the next is functions of RBI. Functions of RBI. There are different kind of functions which are performed by RBI. Let's see one by one. Issue of banknotes. The ultimate authority in India to issue currency notes is the RBI. Except 1 rupee note, all other notes are issued by RBI with the signature of governor and assurance of same amount to be tendered and banker to the government. So this is the ultimate bank. This is the central bank in India. So it is a bank for government. So the RBI has to keep the deposits of government, maintaining the deposits and payments and receivables also done by RBI for the government. And RBI represents our country in a IMF and World Bank as well as. And then the next is custodian of cash reserves. So every bank in India has to keep cash reserves with RBI. With that, the Reserve Bank can control the money market in better way, and the cash reserves helps the banks to improve their performances. And the next one is custodian of country's foreign currency reserves. So the Reserve Bank has the custody of bank of the country's reserves international currency, and the RBI keeps the foreign exchange reserves for the export and import businesses, and it will also look after the exchange rate of currency, and it will enable to deal with the crisis situations. Lender of last resort. The commercial bank approaches the Reserve Bank in the times of emergency. So this is the last resort where the banks can get loan for their purposes, for their emergencies. So this is also called as bankers bank. And the next thing is central clearance and accounts settlements. So commercial banks have their surplus cash reserves deposited in the Reserve Bank. So it is easier to deal with each and other, to settle claim of each other, and through bookkeeping entries in the books of Reserve Bank. And the next function is controller of credit. So credit money forms the most important part of supply of money. Since supply of money is important implication for the economic stability, the importance of control of credit becomes obvious by the RBI. These are the functions which are performed by RBI. Next is objectives of RBI. So the main objective of RBI is to control and regulate a sustainable money market in India. This is the first and main objective of RBI, and later there are other objectives are there. The first one is to regulate the issue of bank notes. So there, RBI the decided that there should be a ultimate authority should be there to issue notes. So the first objective is to issue of bank notes, and the next secure monetary stability in the country. So the making the fluctuations, bringing the sustainability in the monetary markets, and to meet economic challenges by the modernizing the monetary policy frameworks. So they are also making frameworks for modernizing modernizing the monetary framework. With that, we can meet the economic challenges of India. For balanced and systematic development of banking in India, and the RBI also making rules and regulations for other banks to maintain stability in the bank interest rates and other performances, and the development of organized money market in the country. As we see in India, we can see unorganized money market. Still, we can see some of the unorganized money market in India. So RBI is trying to bring the organized money market features and organized money market structure in India, and proper management of agriculture and industrial finance. So they are also, the RBI also looking after about agriculture and industrial finance, and establish monetary relations with other countries of the world and international financial institutions. Though RBI also, as the representative of India in the IMF and World Bank, is also making relations with other countries for the financial stability, and with the international financial institutions also, and centralization of cash reserves of commercial banks. So the bank RBI will be having cash reserves from each and every bank who are located in India. So it is a centralized cash reserves which are in the custody of RBI. So these are the some objectives of RBI. Instruments are tools of monetary policy in India. There are different types of instruments which can be used by RBI to make monetary policy in India. The first one is cash reserve ratio. At a percentage, each bank has to deposit their liquid cash with RBI. Each and every bank who are operating, they must reserve a percentage cash with the RBI every year. With this, the RBI will control the lending level of banks, and the present CRR rate is 3%. That means every year a 3% cash of their profit they have to reserve with the RBI. And the next tool is statutory liquidity ratio. A fixed percentage of liquid assets should be reserved with RBI. So these liquid assets can be either gold or cash or approved securities should be reserved with RBI every year. With this, the RBI will control the cash flow in the banks. If the cash flow is very high, the banks will try to lend the loans. Lending loans, the increase in decreases in SLR affects the availability of money for the credit with the banks, which can be used for loans. Now the SLR is 18.5 percentage. So every year the bank has to deposit 18.5% of their liquid assets with the RBI. And next is repo rate. It is the interest rate at which RBI provides overnight liquidity to banks against collateral of government and other approved securities under this. That means if any bank need money for overnight, so the bank can approach the RBI for liquidity or credit facility. Now, for providing credit for overnight, the RBI will charge some interest rate. So that rate is repo rate. So the repo rate is now 4% for overnight liquidity, which is provided by RBI. And the next is reverse repo rate. So the fixed interest rate at which the Reserve Bank absorbs liquidity on an overnight basis from banks. Now this is the rate at which the RBI will take credit from the other banks for overnight basis. So this is the fixed rate which is paid by RBI to other banks when RBI taking overnight credit for their requirements. Now the repo rate is 3.35%. So next is bank rate. So it is the rate at which the Reserve Bank is ready to buy or rediscount bills of exchange and other commercial papers. So if any bank want cash with their liquid assets, so they can deposit or rediscount with the RBI with RBI. So when they are discounting or they are selling their commercial papers or exchange bills, the rate which is paid by RBI is called bank rate. Now the bank rate is 4.65%. Role of RBI in money market. So RBI is the ultimate monetary policy making authority in India. So definitely RBI will having the control over each and every market which is existed in Indian financial structure. So now we are specially discussing about the role of RBI in money market. So by controlling money market, the cash flow can be controlled over money market. So let's see the role of RBI. The first the measurement or the first thing the RBI will do for controlling money market is by setting a necessary reserve ratio. Money market can be controlled. With this, the restricted loan lending by bank in the market can bring stability in money market by keeping the currency value. So by setting interest rates, the RBI can control the lending levels of banks, to control, to restrict the flow of money. And the next, RBI can influence the supply of money through special deposits. Either there is another um, point, another instrument, another policy with which RBI can control money market is by issuing special deposits. So these are deposits at the central bank which the bank sector is required to lodge. So every bank has to buy these special deposits from the RBI to control of money market. So after buying these special deposits are frozen for period of time to get control over the money market. And there is another scheme or another measure which is taken by RBI is supply of money can also be prohibited by the RBI by adjusting its interest rate which it charges when the commercial bank wish to borrow money. So the repo rate is one of the major instrument for controlling money market. If any bank is approaching RBI for their liquidity, so by adjusting, by increasing or by decreasing, the RBI can bring control over money market. And the other one is RBI may also involve the money supply through operating on the open market, either buying or selling. So either directly RBI can get into the market, and the RBI will be buying or selling securities in the market to bring stability in the money market. These are the measures and the role of RBI in the money market. So ultimate thing is by RBI is to bring stability in financial stability and meeting economic challenges.